it's just the perfect time for gold, and that's why it's taking off. And it has people also thinking, this is going to be, a lot of people think this is it. Gold's going to go to the moon, 5,000, 10,000, 20,000, these, crazy values. And maybe it will. But the shorter term, when you look at just the normal cycles, we're in that late stage, and everything is fun and exciting right now. I have a feeling in this market environment, because it's still, I feel, a little early in the feeding frenzy where people are just piling in. People are now numb to gold hitting all-time highs. It's been doing it forever, it feels like. But silver, I think, is going to spark a hell of a move. I think it's such a tiny market too that I think it could really explode, as I mentioned, like up into the 80s. So I do think it's going to spark a big wave of buying.
Chris Vermeulen, known for his trend-based approach to the markets, emphasizing the power of technical analysis over emotional or purely fundamental decision-making. According to Vermeulen, gold's breakout in 2019 was a perfect example. Technical indicators signaled the start of a new supercycle years before the macroeconomic backdrop caught up, validating the trend. He believes that when technical and fundamental conditions finally align, the result is a perfect storm that can send gold prices sharply higher. While he acknowledges the possibility of gold climbing to $5,000 or beyond, he warns that such parabolic moves tend to be short-lived. Instead, his focus has shifted to silver, which he sees as the more dynamic opportunity. With a much smaller and tighter market, silver can move dramatically with relatively little buying pressure. Vermeulen anticipates that a moderate wave of demand could push prices into the $80 range, triggering a speculative rush that may end as quickly as it begins, an outcome consistent with silver's volatile history. Relating this outlook to broader market behavior, Vermeulen compared today's conditions to the pattern seen in 2007, when stocks and metals rose together for a brief period before diverging sharply. Back then, the stock market peaked while gold and silver entered a powerful 2-month rally as investors sought safety. He sees a similar setup unfolding now, with equities nearing a top and precious metals positioned for one last major upward push. If you found this video helpful, don't forget to like, subscribe, and share to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
So many people buy metals or get into stocks and things on fundamental data. They're like, oh, the economic situation is good, the fundamentals are good, but it might take forever to get to this price. Whereas if you follow technical analysis got us into gold and silver in 2019, when it got us into gold in 2019. And that was when that whole cycle, the next super cycle in gold, started. And that's the nice thing about technical analysis, is when you follow technical analysis, gold peaked out in 2011, and then it went into a multi-year stage 1 base, and then it broke out. Technicals usually get you in before the economic data. So over here it says get into gold, it's starting a new upward cycle, and then finally the fundamental, the economic climate, the whole fiat, like monetary policy is now like, it couldn't be any more in favor for gold. And I know people have always said, well, gold's always been in favor for like the monetary policy to change and fiat currencies. But if you just follow technicals, it will get you in when the actual trend is flowing and in the right direction. And then usually the fundamentals and all that stuff will fall on your lap. You're like, oh, okay, well, now we're in the sweet spot where not only price is up, but now the actual economic environment matches it. And when you put those two together, you get these parabolic moves, the perfect storm. But a lot of people don't get in until the perfect storm hits, like they are right now. And that's why we're seeing this feeding frenzy. It's like, you really technically should have been in the start of the new bull market back in 2019 for gold, or at least got in, in 2024 when it broke out of that multi-year pause, right around, 2100 over here. That's the technicals get you in early. And then if the trend matures and the fundamentals fall on your lap in favor, that's when you get these giant parabolic moves. Everybody's, there's so much turmoil in countries right now. People don't trust the systems, the government, like there's so much going on. It's just the perfect time for gold, and that's why it's taking off. And it has people also thinking, this is going to be, a lot of people think this is it. Gold's going to go to the moon, 5,000, 10,000, 20,000, these, crazy values. And maybe it will. But the shorter term, when you look at just the normal cycles, we're in that late stage, And everything is fun and exciting right now, but it's very short-lived. These rallies are short-lived. They last a few months when it's really exciting, and then they can go dormant for 4 or 5 years again. And that's what we need to be aware of. I have a feeling in this market environment, because it's still, I feel a little early in the feeding frenzy where people are just piling in. People are now numb to gold hitting all-time highs. It's been doing it forever, it feels like. But silver, I think, is going to spark a hell of a move. I think it's such a tiny market too that I think it could really explode, as I mentioned, like up into the 80s. So I do think it's going to spark a big wave of buying. If we look at just drop down to the 10-minute chart. So there are signs that there's some big money investors starting to move out. So this is the 10-minute chart of gold from last week. Twice throughout the week, we saw a big high volume sell-off in gold. We saw that twice. So we're getting up into that nosebleed territory, that there are some big players starting to cut back their allocations in gold. We saw this in silver as well. But all that's doing is just telling us that a lot of people think it's a good price to start locking in some gains. But I do think we're going to see silver, probably percentage-wise, it looks primed and ready to really have, as I mentioned before, a very strong green bar that could just be absolutely ludicrous. And it will suck in the rest of the people who aren't in. And unfortunately, they're probably going to pay a high, and they're not going to see it reach those highs again for many, many years after that. Silver has a great way of putting some pretty explosive moves in and then having epic reversals to the downside. When we get into these feeding frenzies, it lures people in. Like this volatility, whether it's straight up or straight down, lures more people in, because a straight up move just creates FOMO. And there's all kinds of studies that show it's more painful for an investor to watch something go higher without them and think that everybody else is making money but them than it is for them to take a loss. So the faster something goes up, the brighter that bug zapper light glows, and the more people it lures in. And it at some point, once this tide turns, once this spike kind of ends, there will be max like exodus, and it'll be like people scared and they just dump shares. But I think one of the things you kind of touched on is, say you get in and it goes up 150% or whatever, and you're like, well, I'm just going to hold on to it. I think that is the mindset of a lot of people, because they're like, I'm up so much, I can let it pull back, I can let it do its thing before potentially going higher, because they've got a lot of buffer. They're up so much. Generally, though, when it starts to fall, they start to panic and they're like, I'm giving so much back, and they usually get out. The same scenario kind of happened leading in 2007. If you follow technicals, it would have gotten you out. It would have allowed you to repurchase later and then play another one of these moves to the upside. And this would be the same mindset as what you just touched. Is you're in this beautiful trade, I think I'll just hold it. And yes, if you hold it long enough, the buy and hold strategy does usually prevail. But here's the thing: you pretty much wasted 13 years of no returns where you could have put that money somewhere else. Imagine making 13 years worth of returns for 13 years compounding. And so this is what I want to avoid. My whole strategy is I want to avoid the sell-off. I don't mind selling a little bit lower wherever the trend changes. And I don't want to waste 13 years. I want to put that money somewhere that earns money. And gold doesn't really pay you, right? If anything, it costs you money. Whether it's an ETF, there's a management fee, or if you store physical gold, you've got an annual fee. So instead of holding on to it because you like it and you're like, I'll just hold until it goes higher because it naturally will. What if you had 13 years? You could put it in something else that goes up 5 or 10 or 14% every year until then, and then you just get back into gold when it actually says that. And so that's what I focus on. I focus on, it's not about making as much as you can on every move. It's about knowing when to get into a trend, when to hold it, and when to get out, and then to move that money to another asset that can work while this other asset is dormant and not doing anything. So I work on efficiency. I don't want to waste time, and I want to be constantly pulling money out. And that's the strategy I do. And it's not rocket science. It's not super exciting, but it allows us to navigate these markets, and we don't have 13 years of no returns and watching, our individual mining stocks crash and take forever to come back. So I just do things a lot differently, right? As much as I love physical metals, I'm not going to hold them forever. I'm not going to hold any trade forever. If it falls out of favor, I move on, and I can always buy it back later when it actually looks like it's onto higher grounds. We go back and look at when the stock market peaked in 2007. It was just as gold and everything took off, we saw about a 2-month rally, about a 2-month move in the precious metal space and the stock market that pushed up to all-time highs. And the stock market topped out, but the mining space and some of these other risky plays continued to move higher. So just based on the last push is telling me, I think the stock market actually could top out before that. I think precious metals still have, 6-8 weeks to the upside. And as you can see here, as the stock market starts to go down, this is when we see precious metals have that big push. So I think we're about to see one more big push, because right now we are equivalent to like right here for gold, meaning the stock market is about to pull back, and gold, silver miners, and Bitcoin are probably about to shoot higher. Bitcoin's the wild card. I don't know if it's going to move with the NASDAQ or not. As you know, it has a pretty close relationship with the NASDAQ. So I'd scratch out Bitcoin because it has a lower probability, but we're on target for about a 1 to 2 month rally in metals still. 2 more big green bars based on what happened in the past. I mean, it's just a rough guesstimate.
Chris Vermeulen drew parallels between the present market setup and the critical stage of 2007, when equities peaked before the global financial crisis struck. Just as gold then began to outperform while investors fled risk assets, he observed a similar shift emerging today, stocks sitting at record highs, safe haven demand strengthening, and the US dollar losing credibility. This combination, he warned, often signals that optimism in equities is nearing exhaustion and that capital rotation toward tangible assets may already be underway. The mood of complacency that dominated markets before 2008 seems to be resurfacing, suggesting that another major turning point could be forming beneath the surface. Building on this comparison, Vermeulen emphasized that while gold's strength may appear encouraging, the explosive rally in mining stocks carries familiar dangers. The sector's rapid ascent mirrors past parabolic surges that ended with deep corrections once the momentum faded. He cautioned that this phase of euphoria after years of stagnation often tempts investors to believe a new multi-year bull run has begun, when in fact the opposite may be true. If economic weakness or a recession unfolds as in previous cycles, mining shares could suffer steep declines or prolonged sideways movement. In his view, the market is flashing the same blend of excitement and warning that preceded earlier financial upheavals, urging investors to remain alert rather than swept up in the rally. Let's get back to the interview.
Sure, yeah. Well, if we take a look at the charts, there's a lot going on. There's a lot of layers here, and it could be difficult for some people to grasp all the layers that I kind of put on here. But when we look at the S&P 500, which is threatening new all-time highs here on the daily chart, which is on the right, the market just is going through this perfect wave right now where we're in a bullish environment. If we were to look at our 30-minute chart, like this is what I really like, is the short-term charts tell us when we have specific setups in the market, David, for short-term emotions. And so when we look at the short-term perspective, we have the stock market giving us this FOMO indicator. When people hit a certain threshold where a market has moved too far to the upside and they're not on board, then they hit a level where they're like, I just need to get in. And we usually see it happen in waves. The stock market participants are like a school of fish. And so we saw that about a week and a half ago. And then the stock market sold off and took a little bit of a nosedive. And that, when we look at the daily chart, you can see that right over here. So the 30-minute chart allows us to zoom in on the near-term price action and the sentiment within the markets. Now, we did see the market go in this oversold condition, and the market is naturally always going from overbought with FOMO, people piling in at a high, to a sell-off that creates an oversold and they panic out. And so from that panic low, the market has moved up and we're hitting all-time highs again. And just knowing the sentiment is very important. And so right now, to answer your question, stocks continue to just tread higher. They continue to rally. NASDAQ at all-time highs again today. And the market is moving, just the way it should be. Just waves of fear of missing out and then buying. And right now we're seeing kind of money move into pretty much all assets. We're in what I think is kind of a little bit of a euphoric phase here in the stock market, especially in the precious metal space. And when we see everything piling in, it can warn, obviously, of some big trend reversal coming to an end. Because I was talking to a subscriber the other day, and actually a few of them, and they all said every single one of their gold mining ETFs or stocks are up over 100%. And of course, we're long equities, we're long gold. And the fact that everybody is cleaning up in the space, it feels like easy money. When everybody is making a ton of money, you got to be cautious. It's when you need to take the blinders off and start wondering, when will this take a bit of a pause or breather? And so that's what people need to be aware of. And I think the best comparison, which we can touch on if you want later, is a comparison with 2007. And I layer on a couple extra charts here that signal that we are really, really close to a capitulation high, a kind of a blow off top in the precious metals, in the mining space in general. And usually that signals the end for the stock market. So that's one thing we need to be aware of. But until then, you got to ride this market higher. The left chart here, the stock chart in the background, is the S&P 500, and it hit all-time highs in 2007, just before it went off a cliff and sold off 55%. Now, the yellow line is gold, and you and I have covered this. Gold has outperformed. It's on fire, telling us something big and bad is about to happen. People move to physical metals, and it outperforms when they're worried about currencies and economy and all of that stuff. Now, if we were to take a look at where we are now on the right-hand side, stock market's at all-time highs. Gold is outperforming. It's telling us something big and bad is about to happen. And in 2007, we had the US dollar, which is the green line. Most hated. Everybody thought it was going to collapse. If we look where we are now, we've got the dollar down low. Nobody likes it. They think it's going to collapse. You and I have covered this. Now, the interesting part on these is if we layer in what happens just as the stock market is about to top out, and what happens with gold miners and platinum miners. So the middle chart here is GDX, and the bottom chart is platinum. And they have just started to really skyrocket and start to take off to the upside. And as the stock market starts to stall out, which is where I think we're very close to being, gold, silver, platinum, palladium miners, they continue to rocket higher temporarily while the stock market tops out. And so this is like the last kind of wave where the stock market is close to falling out of favor. Gold's going to continue higher. Miners and other metals are going to continue higher. And then, of course, the stock market eventually will collapse, and it'll want to pull gold down and everything with it. So if we were to look at where we are today, we have gold miners have now done that same thing, that rocket ship kind of move where they've taken, dominance and outperforming. We have platinum. It's done the same with palladium. We're seeing base metal miners, anything in the miner space, copper miners, base metal miners, just throw the word mining in it and money is flowing into all of those. And they've just taken off as the leveraged play. So this is telling us there's still much more upside, I think, in the precious metal space, but it's also telling us the end is near. When the music is good and everybody's making lots of money and it's easy, every day it's more and more money, that's when you just need to also be mentally preparing yourself for when this runs out, because when it reverses, we tend to see some big reversals in the market, and you can give back a lot of those gains and potentially not have any growth for years. There's a lot of price action going on. It's pretty exciting. I mean, we're in. If you look at the chart that I have, I'm kind of showing from the lows to the highs back in the 70s to 80s based on percentage moves from those levels, and you can see we're actually not too close to the same percentages. We still have quite a ways to potentially go. But when you look at the price action, the curves on the chart, usually when things start to really go parabolic and start to go straight up, like the last few bars, those are usually the ones you need to be aware of. When it feels so easy and every day just opens higher and higher, no matter what, that's usually a bit of a red sign. And I think, if we look at GDX, the miners, this is a really good example. Just look at the last three bars. It's just popped and gone parabolic. And same with silver miners, pretty much every miner, in fact. They're going straight up. And this is as exciting as it is. The crappy part is people get into like the precious metal space and they hold on to trades for like a decade or so. And it doesn't do anything. And then suddenly, like 3 months, the rally happens, and this is where a lot of people get caught, is they've waited so long and it goes up so fast. It feels great, it looks great, your account recovers, But people think, well, I'm going to ride this. This is just the beginning. But keep in mind, you go look at these rallies, they're all like 4 or 5 months long and then they're dead. But it holds a lot more value. Like the metals hold up. Well, at least gold holds up better, where miners can crash back down. So this is the problem. People have been in the mining space for 10 years or so waiting for this. And then it happens in 3 months and they think it's just getting started. But there's a lot of signs here saying that actually this run could actually be coming to an end and we might go into a big pause. Maybe it won't sell off huge, but maybe it'll trade sideways for 6-8 months, or maybe it'll pull back 20, 30, 40% if the market does go into a recession, just like it did back in pretty much every other pullback in the market. So people just need to be aware that, just because it's starting to rally and it's happened so fast doesn't mean it's not going to last for years. You generally aren't going to see the prices run up when you see this type of price action. It's kind of like a little tulip bubble here.
The current surge in gold and silver reflects a powerful yet fragile phase of the market cycle. Both metals are showing strong momentum, but the sharp parabolic rise, especially in miners, signals growing risk of a pause or correction. History suggests that such rallies often precede consolidation as investor excitement peaks. While fundamentals still favor precious metals, caution is warranted as the setup hints at a turning point rather than the start of a lasting uptrend. Could the current surge in gold and silver be the final stage before a major market correction, or is it the start of a sustained bull cycle driven by deeper economic stress? So stay tuned. For clear data-backed insights into the financial system, be sure to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.